All right, good morning, everybody. This is March 27th, 2026, and we are going to
Broadcasting
run
live from the
through the
financial
Sentiment and
district of
Flow Show,
Chicago,
the latest
Illinois,
edition
your
here.
home of market
Going to be
quotes and
joined
anecdotes. Here's your
today
host of Trader
by
Audio,
with
Dart
Jim.
Trader
So
himself,
that's a nice little
Jim
addition. This is going to
Zarosli.
be
who are
his first
part
time
of the
on
Rebel
it. So
Alliance and the Trader.
obviously,
Take it
Jim's
away.
pretty savvy on the markets, understands what's going on. So he'll be here. He'll help everybody with questions and everything like that, and obviously chiming in with his own read on the market. So, Jim, how are you doing today, buddy? We have Jim.
Sorry about that, Gavin. You'd think I'd know by now to the microphone button when you introduce me. But that's all right. You just got to.
I do it enough to you, Jim. So you owe me one there, right?
Yeah, that's all right, Gavin. The only problem is this one's recorded, so there's
right.
proof. There's proof. Anyway, I'm doing okay, Gav. Just navigating the landmine field that we are on. Looks like we just broke through that trend line that I put in place a while back, and here we are now testing the daily S1. Pushing our way back towards the top of the opening range now. So maybe we got a little rebound in the market. Of course, we saw a tweet from Jennifer Jacobs saying that the White House officials are cautiously optimistic, and there's people familiar with the with the uh, with the talks. Apparently, Pakistan has direct contact with security establishment, controls of the country, and that's coming from a regional source. So that got us popping, that got us hopping here. So we are well off the low now, trading 64.86-ish. So with that said, Gavin, I think we should get ready to roll, and it sure seems that we've had markets go from being crowded to complacent to fragile and reactive, and this is all in the matter of just a few weeks. So I think it's time to break down how vulnerable we are and if what we need to see in terms of sentiment and see where the crowded trades are and whatnot. So, Gavin, I'm going to let you take it away. We will take a look at the big picture and start with the environment. What's got us hopping right now? Is it geopolitics, or fundamentals, or combination of both?
Yeah, well, I mean, look, obviously, no secret geopolitics and oil are driving the markets, but a lot under the surface, too, that we're going to take a look at today. Just the whole point of this show is to figure out where positioning is, where sentiment is, and hopefully provide an advantage to the listener. So that's exactly what we're going to try to explain, and hopefully be able to explain why we're seeing a move like we are right now. And with that, we're just going to kind of pop to slide one there. Market characteristics. I think everyone's pretty aware of the situation. Geopolitics, the primary macro driver, Iran conflict directly impacting risk assets there. We'll talk about some of the knock-on effects. Oil, of course, become a key transmission mechanism into inflation expectations and rates. That's definitely been weighing on things. Sentiment has shifted sharply bearish, and we'll go through a number of the readings there. Credit markets naturally are starting to show some early signs of stress, particularly in private credit. Liquidity conditions remain fragile, amplifying both downside and upside moves, as we're seeing right now. In systemic strategies, they've transitioned from buyers to sellers, which is helping accelerate some of the volatility down. A lot of the things we talk about with the dealer and the gamma flip. So we'll get into that a little bit. And then positioning lighter overall, which increases the market sensitivity to positive catalysts, Jim, which is, again, helping kind of explain the move. So we're going to go into some of those details here a little bit more. First slide I wanted to pop out with was Brent crude here. This is from the Bank of America Fund Manager Survey. I thought it was helpful just to get a sense of where people stand right now in terms of how they think that Brent is going to end the year. And currently, the majority are laying in that 70 to 80 range, with 76 being the average from the responses that we're seeing. So obviously, Brent crude trading well above that. So That would suggest that most people are expecting a reduction in hostilities right at 103.19 right at the moment, up about 1.25. And then you have the 60 to 70 range coming in second. Then 80 to 90 starts piling in, and 90 to 100. So only 3% think that Brent is going to end 2026 above 100. So that does suggest they expect a reduction in hostilities there. Now, the problem with this is this is where it ends the year, where it averages and throughout will continue to factor in. But I did think that this was a good slide just to show people on where most are targeting Brent by the end of the year. Another oil slide here, just kind of showing the importance of what we're looking at. Foreign holdings of U.S. long-term securities have reached 36.8 trillion in January. That's up 52% over the past 3 years. Overseas investors hold 22.4 trillion in U.S. stocks. That's a 76% jump in 3 years, making equities the largest bucket of foreign-owned U.S. assets. Foreigners are also increasing holdings of long-dated treasuries by 24% and corporate and other U.S. bonds by 30%, deepening that cross-border market exposure. So bottom line here is what happens on the global economy needs to be taken into consideration, because if we're seeing areas get hit, then we're going to see money flow out of the United States, of course. Two areas that we're watching closely in particular, Japan, which is, of course, the largest holder of U.S. treasuries. They paid roughly about 17,329 yen per barrel for Brent on Thursday. That's the highest level on record back to 1989. So you got the yen weakening against the dollar and oil surging, which is a nasty cycle for Japan. And then South Korea, Brent costs 161,144 won per barrel, which also raises the risk that major importers could sell U.S. stocks and bonds to fund higher energy bills. So just something that we wanted to take into consideration when we're looking at that impact of oil. When you see Trump say that we don't need the Strait of Hormuz, we might not, but other countries do. And, that holdings of U.S. stocks needs to be taken into consideration. So I definitely want to highlight that. All right. So now we're going to break into some of the items here. And Jim, anytime you want to pop in, definitely feel free. But just kind of running through this slide here. This is taking
Actually,
yeah, Jim.
Gavin, I did. I wanted to ask you what you think are some of the variables that you're going to need to see, that the market will need to see in order for crude to stabilize in this environment outside of peace. What are some of the other variables?
Yeah, I mean, alternative routes to the Strait of Hormuz. It's all about that strait right now, the bottleneck going on there. In fact, there's a second strait that they're talking about that Iran might try to shut down. One that the Houthis have shut down in the past. So certainly, peace talks are going to be front and center, Jim. Then just the ability for alternative routes outside of the Strait of Hormuz. We'll be looking for breakdowns there. Certainly an uptick in production in OPEC nations that don't rely on that strait to transport their oil. So, we got 20% of the world's oil locked up there. So in order to get that unpacked, we're going to need to, again, find either some peace talks, a right for passage through there, or at least an alternative route. But outside of that, that's really the key things that we're watching for oil. Certainly, you can look at an uptick in U.S. production. You could look at an uptick in the Baker Hughes account, which will be the Baker Hughes count, which we'll get here in about 30 minutes or so. There are other items, but until we really get that situation straightened with the Strait of Hormuz, that's pretty much the center focus for everybody. Everything else is just kind of running secondary now. We'll probably see headlines of improvement in transportation in other directions, but for now, it's just going to be incremental drops in the barrel. So that's what we'd be looking for on that front. But looking at the flow of funds here, Jim, A couple interesting notes. Some not surprising, some will be surprising. Institutional positioning. Naturally, they've been de-risked. They have de-risked aggressively. We're talking CTAs, risk parity, asset managers, which creates a market that is lighter and increasingly prone to short squeeze risk on positive headlines, which we just witnessed one right there. So, that's one area where we'll be watching. The systemic selling is likely nearing an exhaustion, according to the Goldman note, with the potential for significant upside flows, and we'll get into that in a little bit. But they have about 86 billion in CTA buying waiting on the sidelines if the market stabilizes or if we start to rally, and we'll start to get into some of the key levels later on. Jim will definitely be leaning on you for some of the levels that you're looking at. Weak liquidity and an unfavorable gamma. They've amplified this downside move and really capped rallies, which is obviously a dynamic that we've been seeing. But this is expected to normalize in April. We just got past a really large quarterly options expiration. We are seeing at the moment more dealers piling into the lower puts, so that needs to be respected and watched. But there are some areas where we're seeing the potential. Again, this is all very reliant on which direction we go on the geopolitical front, but the potential for an April bounce, and we'll get into that a little bit deeper. And then key divergence has emerged. Institutions are selling while retail and fund flow remains pretty strong. So this will provide a little bit of underlying support, but also, of course, increased volatility and position and imbalance risks. But that shows a lot of institutional sitting on the sidelines and retail kind of holding the boat. So if you start seeing institutional piling some of that money off the sidelines in, then that also helps with that April squeeze. So again, pointing towards why the market is so fragile. Obviously, you've got volatility in control. We've been talking a lot about the VIX there, and usually we had that whole short vol activity going on, but now we're seeing everybody getting long vol, and that's just added to everything. We got the VIX right around 30 today, so it's been up above 20 for the most part as we could see. So certainly keeping an eye out on that. Again, the systemic de-risking, CTAs, risk parity, and vol control helped trigger selling below the 200-day. That really just kind of tapped things off. Then you got the exposure reset with vol targeting strategies that have cut positioning by 20%. So again, when you're short vol, you're getting long elsewhere. So we'll be certainly watching that. The liquidity breakdown, with money flowing out, you're just seeing it easier to drop things down. And then the ETF flow dominance, where ETFs are now making up 35 to 47% of volume, which of course, we'll get into SPY liquidity, suggests some further de-risking. So, there's some of the key things on what we're watching there. Now, Jimmy said that there was a question out there.
No, a question for me.
Oh, question for you. I'm sorry.
Yeah, I didn't want to get too far away from from your flow of funds discussion here. I'm curious. So you mentioned that there is considerable de-risking already. The institutions have already de-risked aggressively, as you put it. So my question is, do you think that reduces the downside risk from here?
It does to a certain degree. Obviously, again, we're talking about retail trying to keep things afloat. And there's one slide that we'll jump into in a little bit in terms of where overall positioning stands. That we haven't necessarily seen the end of this, but there's been a lot of forced action once we broke down key levels from the systemic selling pressure that has worked in it, and a lot of this has worked its way through the channel at this point. So, there are some folks that are just kind of holding on and just taking their blows right now with the idea that this will pass and staying in the market. So we haven't seen a complete capitulation yet, Jim. But and again, a lot is going to be determined on how we move forward with oil and geopolitics. So we're certainly not making light of this situation. But I think when we take a look at things, You're going to see an opening for at least a bounce in April. Whether or not that's going to be sustainable will, of course, will rely on oil prices as well as the overall geopolitical situation. So, does that answer your question, Jim? You got to follow?
Yeah,
Yeah.
yeah. My follow-up is, do you think there needs to be a flush from the retail holder before they start putting some of that money on the sidelines to use?
Yeah, I mean, there is that element that could be helpful. Certainly, again, we might not need it for an April bounce, but if we see a bounce in April, my expectations would be for that to roll, and this would be going off of, the situation in the Strait of Hormuz worsens, and the oil prices are holding up at 110 a barrel or whatever, and from there would definitely lead to a potential for further deleveraging and further selling going on, and then get a flush. Now, that could very well be what dealers are searching for here, but I don't think it would be necessary just yet for a bounce. But it might be a little bit more necessary again if this situation lingers and we start really working our way down the list there. So something that we're certainly watching, but we haven't seen anything yet on the retail side that suggests that they're running for the hills.
All right.
All right. So liquidity positions, we were talking about that. Just kind of leading to, Jim, I know you've been talking about the volume gaps religiously on a daily basis, and this kind of helps set the tone for that. This is from a slide from Citadel with source in Bloomberg information, where it just talks about the liquidity in the ES sitting at year-to-date lows, dropping to the third percentile. So again, that kind of leads to some of those gaps that we're seeing. Obviously, makes trading a lot tougher there. But you can kind of see it in this slide where liquidity stands for the S&P futures. It just kind of helps explain some of the moves that we're seeing. Moving on, here's the ETF net inflows, just kind of supporting that ETF argument, where this is where people go when we talk about the SPY liquidity often, when they're uncertain and they're getting away from stock picking and just kind of trading groups like the IGV or anything. So that's pretty evident. Look at that inflow. This is just for the first part of 2026. Massive amounts of money being put into ETF strategies there. Here's the SPY liquidity premium. This again, when people are in doubt, they start trading a little bit more as a group here. And also a lot of the ETFs too, they're those inverse ETFs, of course, right, Jim? You got the FAS, you got the SPXS, people just piling into those in order to find a way to profit from the downturn. Now, the SPY liquidity, Jim, this green line here, that represents an extreme. And you can see the last couple of times we've gotten there, you can see this big spike up in April, right around the Liberation Day headlines. And from occasion we've seen this pop in, and like you can see the low there right in May with corresponds right with that spike in the SPY. So this doesn't mean we can't go higher. Obviously, there's been episodes where we have, but we are starting to get into a little bit of extreme territory on that front. All right. So moving to the setup shift. Now the gamma being less restrictive. Now I was talking with Mr. T a little bit about this earlier. This is his ballywick. So this one of the things I was seeing in the Goldman slides from their flow of funds was a weaker upside gamma wall. So that's going to allow for sharper moves higher. So now we still have downside pressure coming from the options activity. That flip below the 6,600 level really kind of set things off. It was an area that we had been watching. So, we are following that closely there, but there was a flip from Goldman's perspective on the gamma wall, which is allowing for a little bit of spikes here and there. The other thing we got is quarter end catalysts. So we saw options expiration. I think it was 6.5 trillion or so rolling off. Now, what you want to see is where are they rolling to, and right now they are starting to roll lower. So that's something that we'll need to watch for a quarter end catalyst. But the other thing that we do want to point out is you got pension rebalancing. So that comes right at the end of the Q1. So we're going to see where capital starts rotating towards. Does it start rotating back into the U.S. and some mega cap tech and quality? Recall last year, really strong numbers for the international. We were just talking about the impact of higher oil prices for a lot of the international countries. Do they start flowing back into the U.S.? It's going to be a key question that we're going to need to watch. The next thing is seasonality and retail tailwinds. So April strength, we get those tax refunds coming in. They have been coming in a little slower. So we're expecting a move there. And also we'll show you a slide because of this. April does tend to be one of the stronger months. And then the bearish setup, bullish risk. Sentiment is washed out. That might be a little too aggressive on it, but it's certainly tilted a lot more bearish, and we'll hit that up. And then, this helps skew risk reward to the upside there. So again, a lot of this is going to be dependent on what oil does, geopolitics and everything, but it does set up for an April pop. Jim, you got any thoughts on this slide?
No, not this one yet. Let me
Okay.
digest it just a little bit.
Yeah. I mean, like I said, first time me and Jim are doing this, so we're learning our cadence and everything. We'll continue to improve from here, and I'll certainly work Jim in a lot more.
Actually, Gavin,
Yes,
I do
sir.
have a question. When I was looking at this a little earlier, and if if the if the market's no longer pinned by options positioning, how does that change the market dynamics that we're seeing?
Well, I mean, so if you think about it, the dealer activity, right? It would change whether or not they need to sell in a certain levels or buy at certain levels in order to protect their positions, or whether or not it flips to forced selling, of course, right? So we'll be watching where these options roll into. Again, a lot came due around options expiration there. So, the big question is, do they put these on at lower levels? And that's kind of what we're watching there. But so far we are seeing that, but naturally not at the level that we had seen around options expiration. So, not as much need to drive forced selling as there would be, is I guess how I would look at it. Does that answer your question?
Until when? The end of next quarter?
Yeah, I mean, well, you're going to have options expiring at all different lengths, right? So you'll have an end of month strategy, certainly an end of Q2 that starts taking place, and then we got the daily zero DTEs all factoring in here. So for the longer term, we're going to start seeing that roll into the monthly, and it'll be a little tougher to roll in aggressively into the quarter end, just start given the uncertainties that are taking place. But that flow is something that we're going to be tracking a lot of just by watching where those buyers go. We started tracking the VIX pretty early. So that's going to remain a key area that we're going to want to watch. Do we continue to see that VIX buying? So far, we haven't seen it as aggressively over the last few weeks, but we did see plenty of folks rolling over into the April 15 VIX expiration and the May 17 VIX expiration, I think, but not to the levels that we were seeing at the beginning of the year. So that's something that, it's just going to be one of those things that as it starts unfolding, we'll get a better idea. One of the other key is we're not really seeing much of out of the money calls being bought. So there hasn't been any upside bets being put on yet. There was a leap one, if we recall, a couple of days ago for 8,000 calls. So that was probably the only thing that we've really seen on that front, but it's certainly something that we'll be tracking. So for now, Jim, I guess the question is, we're watching that flow to see where it goes to. And, this kind of brings in this Goldman dealer spot gamma slide that I was looking at. So we're looking at that break even line there. And this is the gamma exposure that I was referencing from the Goldman slide, where you're seeing it get less and less. So now you do see it start building up here, and it's likely to build up throughout the course of the quarter as well. But for now, this just means that with less gamma exposure, they don't need to be as active in terms of capping rallies or buying what you may call it, or buying dips at the moment. So again, it's just an element that we're going to continue to watch to see how it plays out. But the Goldman one suggests that that forced selling that Gamma puts in, that's been part of that downward weight that we've seen. Nice steady selling, right, Jim? You're not seeing those big capitulation pukes. It's just that grind down lower, very similar to what we see generally when passive funds are in control, and you see the gamma as the tailwind just kind of grinding us higher. So as that reduces, we should get a little bit better feel of positioning, and without that systemic input, a little bit better feel of the true nature of people who are buying or selling. Does that make sense?
Yeah, it does. What do you think, using this, what would a true capitulation look like baking all this in?
Your typical obvious pop in the VIX there. One of the key divergences that I'd note is if you look at the VIX and you look at the put call ratio, I'm sure a lot of folks are scratching their head on why the put call ratio isn't going higher. And, from my perspective, it's because a lot more people on the long vol front are using VIX, obviously. You're not getting as much short VIX in there naturally, too. But the put call ratio, I think a spike there would signal a little bit more of a capitulation in some of the broader markets with the institutions and certainly the retail sellers there. And we're going to take a look at the robo-lobo ratios a little bit later. But from my perspective, you'd want to see a big pop in the VIX and a big pop in the put call ratio and sentiment readings really to start hitting extremes. Your typical capitulation readings, I would say, is what we'd be looking at, Jim. I don't think that there's anything necessarily out of the book that I'd be looking at. So, that's kind of my take on it.
Yeah, and I was more so asking so that others had an idea of what to expect to when we do see it. When you and I start talking about it, it might refresh their memory that, oh yeah, this is what we talked about in the sentiment and flow show, and some of these levels. Mr. T, even in the chat right here, he was highlighting some of the levels here. VIX over 3688, and right now we're trading what in the VIX? We're trading 29. We're a little above 29 here in the VIX. So just to give people some perspective of what we might see.
Yeah, and professional stock trader live there. It sounds like you might have Jim's charts up. If you pop over to mine to Event Trader, that should pull up the slides. As an FYI, I will be providing the slides in a PDF and sending that off with the replay in about an hour afterwards or so. So hopefully that's helpful. And all these slides again will be in a PDF form, so you'll have a full view of them and to go through. All right, Citadel's SPX seasonality here, Jim. Look at that for the SPX April, the second best performing month behind December. So again, a lot of that's that seasonality with the pension rebound as well as tax returns. So April, a strong month there. This is going all the way back to 1928. So
And earnings.
And earnings, exactly. So and we're going to get into the earnings here in a second. So Bank of America Fund Manager Survey, a couple of key notes from that. This was released last week, of course. March survey turns bearish as Iran plus private credit risks unwind the prior frothy bull setup. Cash jumped to 4.2%, so that's a sell signal reset. Macro shift, growth optimism collapses to 7% versus 39% in February. Inflation fears are surging there. Rate cut expectations fade. Yet recession risk still largely dismissed with just 5% predicting a hard landing. You got risk regime change, geopolitics plus inflation replace AI bubble as the top tail risk. No surprise there. 63% flagged private credit as the biggest potential systemic shock. No surprise there. Clear move from boom to stagflation. Long commodities, still overweight equities, though, in emerging markets, Japan, and cyclicals, while consumer discretionary is heavily underweight. The crowded and contrarian setup. Crowded longs were gold plus semis, but gold, that might fall off that list pretty soon. Bank of America flagged the contrarian trades, favoring bonds and consumers and upside in under-owned areas such as Mag 7 in China if geopolitical risks were to ease. So, a couple of things to keep in mind there. So, there's that cash level chart. You can see it's popped out from the bullish extreme level. That's that bottom red line. Kind of still a little bit more on that side. So there is more cash on the sidelines, but it's not like it was back in, say, April of 25, when we had that flip around the pop there, around the whatchamacallit, the Liberation Day rebound, and nowhere near that October 22 lows there. So, or highs, I should say. But cash levels definitely becoming a little bit more favorable for a bounce, especially a short-term bounce. Then you got investor sentiment that fell to a 6-month low. Again, still elevated, not quite at the lows where we saw at the trade wars, or you can see the SVB issue, the trade wars back in 2019 as well. All were lower than this. So sentiment's gotten more bearish, but not at extreme levels. And we'll break down a number of these. Equity allocation. So, Jim, I know we were talking about, capitulation. Certainly, this would be something that you would want to see a drop off of. FMS, according to the fund manager survey, equity allocation did decline at 37% overweight from 48% overweight. But, this just kind of goes to show that the systemic selling and the issues having and the underlying strength. Now, it's when these start to crack where you start getting that capitulation. Does that answer the question from earlier, Jim? Kind of help provide a little clarity on that?
Yeah. How frequently is this updated?
Monthly, on the monthly basis, right? Usually around the 17th.
Okay.
So this would be from March 17th. So one would expect that we'd be coming down closer to, probably knock another 7% off or so with the decline over the last week, I would say. So, again, something that we're watching. You can see that dip down in right around early 2025. Again, I'd expect to see a further pullback on this. But it goes to show that investors aren't running from this market just yet. They're waiting around to play a bounce.
All right.
The St. Patty's Day read might make it a little sloppier there. All right, here's the NAAIM exposure, and you can see that's pulled back a lot too. We hit that high of 103 in October, and since then really been on a steady decline. And we're going to break down these numbers a little bit more. Now you can see, again, hasn't gotten to that extreme level that we saw around the trade wars. And this is where that downside is, Jim, right? Just kind of, again, watching an exposure. Certainly people have been de-risking, but not quite the levels that we've seen for capitulation in the past. So here's kind of a breakdown. It's dropped from 100 to the low 60s. Managers do remain net long, so not outright bearish. Really, the same thing we saw in the AAII. Volatility is reading signals uncertain. Is reading the signals as uncertain with tactical positioning. Again, something we've covered a lot. And then the trend reflects a fading bullish conviction, but not capitulation. So again, you can see where that dry powder sits on the sidelines, and conviction still remains bullish for a potential bounce in April.
It almost, Gavin,
Yes, Jim.
seems like we could be setting up for a squeeze if headlines actually turn favorable.
That's kind of the point that we're getting at, right? We talked about some of the liquidity that opens up for tighter squeezes. We talked about the gamma flip there. If we do start getting above Mr. T, throw in the room of misquoting here, but SPX 6600, I think it was 6595 to be exact. That's kind of the GEX center for the SPX, and if we were to flip there, you could see a big squeeze from the CTAs, from all that systemic selling, the CTAs, the dealers, everybody there, that they would need to start chasing this market, right? And that kind of sets that up. And that could be the market just digests anything. Now, I think if we didn't see much of a resolution and we saw that April pop, it would be something that you'd see a lot of this money selling into potentially. So, again, obviously it's a very fluid dynamic there. But yeah, Jim, to your point, exactly what we're talking about. A lot of things shaping up for a potential squeeze on the proper headlines.
All right. Well, we'll be on the lookout for those.
Yeah, yeah. So, okay, just breaking in some of the other slides here, just in terms of some of the credit issues and some of the market dynamics. Over investing, you know, right now, this is the February slide. This had pulled back in March, so we are seeing a little less concern with some of that over investing going on. Here's the CFTC positioning from the Goldman flow shows. Again, you can see that big drop down in the CFTC positioning. So that lines up for, again, a squeeze, Jim. This is part of the dynamic that's been creating a headwind. And you can see it pop down to that red level there. You can see the last few times it did that. This would be back in 2024, 25, or in 2025. Again, it happened around July when we were getting that selling pressure in late in 2024. So you can see when this gets down this low, this is the S&P futures and asset manager positioning. You can see how aggressively short they are on this. So again, leading to a potential squeeze on that given the right headlines. Lobo put call ratio, Jim. Not seeing any extremes here, but that again points to that put call we're just talking about, where you're not seeing as much. And again, the Lobo. This is the institutional players. So they need to. They're not really looking for a ton of downside protection at the moment. They took it at the end of last year, and now it looks like they're unwinding it a little bit more. So we'll see if this continues to trend higher. But again, this is the Lobo. This is more the institutional folks. And then here's the Robo. Again, we are seeing people nibbling at some of those puts, but not aggressively yet. Not as aggressively as we have in the past. And yet another area where we are watching here closely. Again, Jim, when you're looking for capitulation, you'd probably want to see this spike up a little bit more towards that extreme level in the green. So that's some of the Lobo and Robo ratios. Robo, you can see a little bit more up towards that green there, right? So, that's part of the reason why the retail crowd is feeling a little bit better about its positioning. We're seeing those closed calls being bought, things like that, that are haven't quite gotten into the extreme, but are moving up there to a point where they're relatively well downside protected and allowing them to stay in a little bit longer. And here's the equity hedging. Again, moving up, not quite at extreme levels as we saw in April, but have moved up higher. So again, a lot of protection to the downside there on the equity hedging front. So, Jim, any thoughts on those on that positioning?
No, Gavin. I did find the Goldman CFTC positioning very interesting as we're hitting kind of that low level. Just out of curiosity, when we've reached that level or very very close to it, I can't see quite as granular, but last time we hit it looks like right around the same time last year where we dipped below it. What did we see from the markets when that happened?
Well, as we could tell, that's right around the lows of the Liberation Day, right? So it's an extreme signal, and that is exactly what we're getting. Again, this is on the systemic side of things for the most part, but when you hit these levels, when you're down minus 50 in positioning for asset managers and the S&P futures on the negative side, then that could lead to whipbacks there. As what do we need for a short squeeze? We need over positioning on the short side, and that's exactly what this reflects there, Jim.
Okay.
So again, the Tinder is there for short squeezes on the proper headlines. That's a big point of what we're looking at. One of the tough things why it's so tough to short right now, too, of course. All right, let's take a look at some of the sentiment data points. We got a number here. Here's the latest AAII. No surprise, that remains elevated on the bearish front. We've got the bull ratio here. Jim, here's another one from Sentiment Trader where you can see again that green line that represents the extreme for extreme bearishness. We're not quite above it, but just like that CFTC line there, Jim,
Mm-hmm.
you can see we're getting close to that extreme bullishness. And then again, you can see that in 2022 when we were raising rates and long duration assets were under a tremendous amount of pressure. So not quite at that level, but sentiment is certainly gotten a little bit more dour. Again, kind of pointing towards maybe not getting that flush out that we want, setting up for the bounce, but it doesn't mean that we'd be out of the woods on the downside when we're looking at it a little bit more medium term.
All right.
Goldman
Yeah.
Sachs Goldman Sachs Panic Index. This is over the extreme level. That's a reading of 9. This is a combination that Goldman puts together of different readings that they have on that systemic side. So again, another extreme level on the panic side based off of systemic selling. Fear and greed. Extreme fear right now at 19. 1 week ago was 17. So we've been lingering down here. This is kind of, Jim, you love those RSI reads. This is, that RSI remaining under 30, right? And you look at it a month ago is at 42, which obviously would have had some fear. 1 year ago at 28, which is, of course, when we're rolling up to Liberation Day, right? Must be something with early April announcements that Trump likes, because the April 6th announcement's nearly going to be to the year, 1 year to the date of the liberation side. But again, sentiment just really factoring in here. The other thing, Jim, is monetary policy. We've talked about yields. You can see this from the Bank of America Fund Managers Survey. Short-term rate expectations catching up with the rising inflation outlook. So this is what happens when central banks start turning hawkish. You can see, this goes back a quarter of a century, and you can see when we started seeing spikes back in 2019 when Yellen started hiking. 2022, you see that move higher when we were slowly raising rates at the Fed there. And this is once again turned higher, which is another headwind for the markets because obviously yields have been marching higher, and that's been pretty evident in what we've been seeing playing out here. And those short-term rates, let's not forget, that's where a lot of the funding in the U.S. is gone. So as these short-term rates go, the funding gets a little tougher. Another headwind for equities. And that, of course, bleeds into credit conditions there. So you can see, though, this is interesting. So we know the private credit concerns have been growing. We know that software has been getting hit. But when we look a little deeper at the people who aren't just looking at the Financial Times headlines or whatever it might be, the counterparty risk. These are the banks working with each other. Nowhere near a big concern yet. Now, we could see this spike up, but when we look at it compared to the great financial crisis, it's rather laughable. And again, this provides support for the items around private credit where it's more of a liquidity issue than a systemic credit issue, at least at the moment. Again, you want to keep an eye out on things. Does oil start leading into some of these countries that rely heavily on dollar-denominated debt, as well as as well as oil imports, do they start defaulting, right? That's some of the things that we'll be watching. That could certainly lead to more of a systemic event. But I thought it was important to show, given the concerns around credit conditions, that there is hardly a panic in the counterparty risk. And that's really when you really need to start getting concerned.
All right. What do you make of that buildup in some of the? Um, I know you and Mr. T had talked about some of the. Uh, Gosh, what was it? The was it default spreads or
The credit default spreads?
yeah, the credit default spreads that we're seeing big bets to the downside?
Yeah, Oracle, I think, just hit a 5-year high, I believe it was. So yeah, now that's certainly been a little bit more concentrated in the software names. Obviously, more bets going in against that. So bears watching, and if that feeds into the loop, which it did back in the Great Financial Crisis, of course, when all of a sudden everybody started getting freaked out about who was selling the CDS, then yeah, that starts rising. But that it's one of the reasons why that Unity report was so important. Right now, a lot of software is getting demolished on sci-fi theories. Right? You had that Citrini research note a couple of weeks back talking about worst case scenario for software names about the AI adoption and everything like that. I don't think we're quite at that level of, completely trusting AI to do everything that it's going to erase all the software names. So when we start getting into Q1 earnings season, Jim, and again, that's why Unity was important and what we'll be looking at. We'll be looking for any notable deterioration in fundamentals there. If we don't see that and we see cash flows continuing to perform well, that should help settle some of the CDS spreads. But again, it remains a fluid issue and something that we will be obviously tracking closely in the coming weeks, and particularly going into earnings season here.
All right.
So I know you love earnings season, Jim, and that's our next chart here, or next slide. So Q1 earnings season, we saw a growth of 12.5% year over year. That was the 11th straight quarter of earnings growth and the 6th straight double-digit increase. For Q2, analysts are projecting growth of 17.8% year over year and revenue growth of 9% year over year. So we'll be watching this closely. Obviously, you want to see them hitting those numbers on a valuation standpoint. The next two get a little bit more interesting. So here's the thing, Jim. Going into Q2, we have seen markets pull back. We got the Qs in a correction now, right? And a big pullback. The earnings per share numbers have been revised higher by 5.1% in that time frame, which is making that valuation a little bit more attractive here, and that also starts factoring into things a little bit. But one of the things that could put that in jeopardy is, and we were just talking about it with Carnival, what does guidance look like moving forward here? You got to think that the CEOs will take advantage of the weakness going on and lower things a little bit. So right now, though, analysts projecting earnings growth of 18.8% for Q3. This is all FactSet data, and revenue growth of 8.2%. And then Q4 looking at earnings growth of 18.1% and rev growth of 8.1%. And then for the full year, that would equate to 16.3% earnings growth and rev growth of 8.3%. Bottom line, earnings are expected to be very supportive of the markets. And, if we start seeing a little bit of a bounce, we start seeing a little bit of an improvement in the situation around the Strait of Hormuz. Don't need a full peace talk, but something where it suggests hostilities may have settled for the time being. And you start getting people excited about earnings. You got the banks coming out first. We saw Jefferies. The fundamentals for Jefferies were fantastic. It was those credit worries that kind of weighed on the stock. We start getting those, Jim. The positioning, the systemic, that all leads to that potential for a bounce. And as we saw going into the Q4 earnings report, people like to run back into those mega cap growth names in front of the earnings, and that could certainly be a big lift. So, Jim, I know you do follow earnings closely. You got any thoughts on this?
I find that interesting. That the expectations are that they're moving things up instead of down, right? So a lot of times they'll walk these things down, the
Yeah.
earnings estimates. So to move them up a bit, I guess that does lead into the seasonality about April that we talked about. Is we have a lot of potential catalyst if we, you know, get some type of positive headline. We have money on the sidelines, good earnings. That probably sets us up for. It sounds like, Gavin. It sounds like we're being set up for a pretty nice April. Not only that, that whole JP Morgan, put spread
Yeah, the collar.
gets yeah, that collar gets expired, right? It expires at the end of the month, so that's kind of out of the way too, right?
Well, they roll that every month, right? So again, kind of watching to see where the bodies are and where they go, right? So but that is certainly something that people will be watching, and also, again, that whole systemic uh, transition as we get deeper into Q2 is something that we'll be reporting on daily and following closely to see if we do get that flip where it starts turning into a squeeze. So, again, we'll come back and recap all that towards the end. Right here, Jim, based off those earnings, I mean, this is some of the numbers that we got. So current PE ratio for the S&P is at 20.3 times. 5-year average is 20 times at this point. We talked about the changing of the guard there in terms of what the new average should be. This is obviously average on very high on a historical, but as you can see, that 10-year is also starting to come up at 18.9 times. This has to do a lot with the productivity, the improvement in the U.S. economy, and one of the underreported stories, the efficiency of corporate America, that's really helped provide that increase in PE ratios. But we're not over priced or overvalued at this juncture. The forward 12-month PE at the end of Q4 was 22 times. So we have pulled back from that. And again, here's what we are just talking about. Since 12/31, the index had fallen 3.2%, even more than that now from that slide, while the 12-month EPS estimates had risen 5.1%. So again, valuation is not a headwind for us. Uh, Real quick, just wanted to throw in the AI bubble slide that we got, since that's been such a key driver as well, and coming up to earnings, something that we're watching. 51% do not think that AI is in a bubble. Now, obviously, we've had a pretty good correction there, but the thing is that we are going to be. I don't think people will be as nervous as stepping their toe in as we saw in February, when a greater percentage did think that we were in a bubble. And same thing with January. We've seen some of that numbers pull back in. So there's that. So before I go into the takeaway here, let me take a quick look at Sydney's question. Is that the whole point about the earnings slide is no analyst has factored in the slowdown due to oil? That is a big factor, Sydney. And again, that's going to be some of the areas where we're going to be looking at for guidance. Now, obviously, they're not factoring in a prolonged slump in oil, but or all the other materials too, right? Helium and everything like that. So, that's going to be something that we're watching naturally when earnings rolls out. Do we see really strong results and people sandbagging on their earnings, but the market's pushing higher because the resolution looks like it's in play, and we have the belief that people are just sandbagging on their guidance? That would be one element. The other would be naturally if all of a sudden we see a strong fundamentals, but nothing's gotten resolved Perhaps we've gotten a bounce at that point, yet we start seeing that weaker guidance weighing in on valuation and weighing in on the forward earnings outlook. Does that lead that bounce to get faded? And, that's probably going to be, for now, unless we see a market change, my take on where we're headed. So let's get into the takeaways based off of that. So, again, 5 key takeaways from today's event. Liquidity is thin and flows are driving volatility, but fundamentals remain intact. So fragile, but not broken. The positioning reset, systemic and institutional de-risking has reduced downside pressure at this point. But again, it's a positioning reset. Do they continue to roll lower, or do they start working their way into some of the higher end elements? Something we'll be watching. Sentiment's bearish, but not capitulation just yet. As we saw, investors are cautious, but not fully washed out. This could leave room for a potential squeeze. The gamma tailwind, so a little less restrictive on the dealer positioning there, but again, continue to track that development as we see positioning getting put back on following that big quarterly expiration. And then the risk reward has shifted upwards in the near term. So, with seasonality, flows, and positioning align, the balance is tilting toward the upside. Now, the big caveat, of course, is if crude and geopolitics can cool. So, here's my general takeaway, Jim, and I want to hear your takeaway from it. But, I do see a little bit further pressure going in towards the month end here, but we are getting a little bit closer. Monday is going to be the 30th, and then Tuesday, of course, month end could lead to a little bit maybe of capitulation towards the end of this session today going into the weekend. But there is the setup for a bounce, and if that bounce does start gaining steam, for it to be a relatively violent pop back. Now, obviously, you need to see the headlines around April 6th play ball. You need to see Brent cool under 100, I would say. Doesn't need to pull all the way back, but to cool off. But, that sets up the tinder there. Then, obviously, we start getting into Q1 earnings season, and we're going to keep an eye out on whether or not the earnings are playing balls, the fundamentals are playing balls, and then playing ball, and then, of course, what the guidance looks like and how that impacts people. Now, that does have the potential to weigh in on things if we do get an April bounce. So my general take of it is that we set up for a bounce, and then, as long as the headlines play ball, and then it's going to come down to what earnings do and how we progress with the discussions on whether or not we're able to maintain strength there, or if we get a rollover that could potentially lead to a little bit more of an aggressive roll down and that capitulation to kind of clear things out from the positioning. So, Jim, what would be your takeaway from this?
I think it's fantastic timing that you put this together when you did, because I think it's going to be really important based on all these factors. It sounds like sentiment is shifted closer to the bearish, the bearish positioning, and with all the potential catalysts that we could have, I don't know how many downside catalysts we could have other than all out, an escalation of war, right? I suppose earnings could come and really disappoint, but just based on the way the analysts are moving numbers, it doesn't seem like that is a huge risk. I mean, they would have to be so far disconnected from the market to be moving estimates upward in an environment such as this. So I think there are potential upside catalysts based on positioning. And let's not also forget, next week is a shortened week, a holiday weekend, right? So you're going to have, Good Friday will be off. The
Jobs number still comes out Good Friday, though. Let's not forget that.
Yeah, and so you got that. You've got, Easter Monday for European markets. So foreign markets will be off. So liquidity could be light. That could set you up for a squeeze just right there. As we've seen, holiday weeks, you can see a squeeze going up. Look, my kids are on spring break next week. I'm sure that's a lot of schools and people may be off the desk. That's another thing that could set us up for an interesting environment. I mean, and it could go both ways. I mean, we could get a capitulation at the end of the month and then a quick snapback come Tuesday or Wednesday, and then heading into the to the long weekend. So, yeah, there's definitely some catalysts that could set up for some very dynamic trading, I would say.
Yeah, yeah, and I mean to be clear, let's not contort a aggressive bounce with being bullish, right? So, again, there's a lot of things going on around with Iran naturally. So we'll be watching those play out. And, if they continue to worsen, I definitely don't believe that we've hit the lows for the year. But this is more just to kind of set you up for the potential if we start getting a little bit of momentum there for a aggressive bounce. And then, if we do get that, say back up to the 6,800 level, maybe even to the 7,000 level, that's where we start looking aggressively to see for follow through, to see if we're going to get any more money coming off the sidelines, or if we start rolling back and get some of that money that we're talking about, Jim, that still remains in the market shaken out. So a lot for us to watch. But wanted to make sure that everyone was aware of this dynamic going into April there. So hopefully this has been helpful, and naturally something that we'll continue to discuss throughout the course of the next couple of weeks.
All right, Gavin. Well, hey, I appreciate you putting all this together and going over it with us all. It seems like it's great timing for this. And if nothing happens, I find it hard to believe that nothing will happen. However, we have to set up what is potentially on the horizon, and just based on all the things that you said, there's a lot of key takeaways here. Yes, we're fragile, but we're not quite broken. Positioning has potentially resets. The sentiment being cautious. There could be a pretty strong response to some positive catalysts. So we
Yeah.
shall see.
All right. Well, Jim, thanks a lot for popping in. Moving forward, I'll work with Jim a little bit more closely on these, so we can certainly integrate a lot of his levels and his charts and everything. So he could be more of an active participant in this, because obviously we want to hear what he has to say on the markets too. So, but thank you, Jim, very much for popping on and doing this. It's a lot easier to do it with somebody else than just kind of talking away here.
I hear you. I hear you. All right. Well, with that said, thanks as always, Gavin. And I think President Trump is going to be speaking soon.
Yes, he should be out any minute there. So we finished up just in time for that.
All right.
All right. Thanks a lot, Jim. Talk to everybody soon.